Hello, everyone. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy here at TradeStation. It's great to be with everyone. Let's just start off with some initial disclosures. Be great to see everyone. Interesting market here, just kind of drifting, making a slightly higher high, very tight range. As the old saying goes, people say often, not to short a dull market. And it's kind of what we have here. Extreme tightness, stocks sneaking to new highs, and some interesting sort of things we're going to be looking at today in terms of this market breadth and the way things are widening and changing in various ways. New haves and have-nots potentially popping up. All right, now as usual, we're going to start here with some of our things. If you go to tradestation.com, go to Insights, and then go to, make sure, if anyone can just tell me, go to this blog here. I'm going to just quickly share a few little points in the comments. And these are just some of the key things that we often share with you guys, ETF disclosures and things like that. So put that in the comments. If anyone could just shoot me a quick message, make sure you hear me okay. And it should be interesting here. All right. Now, this post has a series of different points in it. We're going to be going through and kind of talking about that. But first, remember, we do have a zip file that you guys can access if you click here, and then the zip file will actually, provide you with some different, resources available on the TradeStation platform. It has some studies, and then it has workspace. We're going to be using a few of those. So let me start off first of all just by showing you some of our standardized returns for the ETFs we're going to be talking about, in case any of those are of interest to you. We are going to be talking about some of the ETFs here, so it's kind of interesting. All right. Now, I'm going to start off by saying advanced micro devices was a very interesting one to watch today, but it was more interesting to watch it yesterday because it did very little. It had an inside day, and that's going to be one of the things we're going to be talking about today. Inside days and outside days. There's some interesting patterns popping up along those fronts. I'm going to show you how to find those using the TradeStation platform, because some of you are going to want to wait and watch to see, because there's a lot of great ways you can combine some of these individual candlestick analyses with different things, other kind of moving averages or other kinds of technical patterns you might be wanting to look at. But I want to mention that the inside day on advanced micro devices was really interesting to me yesterday. Look at AMD here, and wait a second, AMD. It had this tight little movement. It made a slightly higher, a slightly lower, lower high, higher low, inside, and then today got the explosion. All right, good. You guys are hearing me okay? Very good. All right, so anyway, we're going to get to that, but I want to just mention that this is interesting because this is what you often see when you're kind of in the midst of a move. It's a continuation pattern. Something rallies, you hope for a pullback, don't get much of a pullback, and then you just get continuation. We've talked about it a lot in this webinar, and right now that is the trend we're seeing in the market. So until the trend changes, or we see any kind of invalidation of it, it's usually can be the sort of thing people want to look at to just kind of sticking with the trends that are established. And right now, tight consolidation within the context of an uptrend, things like inside days has been the pattern. So, okay. Now, I also want to mention right off the bat, we're going to go here to our key ETFs, and we're going to go to this ranking here. So what I'm looking at here is I'm looking at all these different ETFs. I kind of organize them thematically: risk on cyclical, risk on growth, things like that. And I want to just show really quickly, if you look in the last month, for example, look at software, IGV. If we look here right now at the, at technology, it's interesting to actually see that in the last month, technology has actually underperformed. But what's interesting, if you look in the last month, chips have outperformed. Okay, so within this tech space, there's essentially chips, software, and then there's hardware like Apple and Cisco and a few others. But there's really three groups. It's kind of like Apple, chips, and software. Those are like your three groups. And what's interesting here is software is outperforming. I mean, semiconductors are outperforming. Software is underperforming. This is telling us something. At the same time, so I think what we're seeing here is we are seeing, in my view, We are seeing people unload high multiple software stocks and moving into semiconductors and then other parts of the market. The real thing to characterize this, in my view, right now is essentially we're looking at a market that has much more of a kind of sense of cyclical strength, and things like software are non-cyclical stocks. I mean, they're not going to do well in a recession, but when the economy accelerates, high multiple software stocks are not where people want to be. They want to be in semiconductors, and they want to be in things like materials that we're going to be talking about today, because there's a lot of interesting price action in material stocks, which are really doing some interesting stuff. So anyway, what we're seeing Apple, Alphabet. These are now source of funds. People are unloading these and moving to other areas. I think it's important to keep that in mind. Another important thing, I'm going to look quickly at my trading view chart here, but when I was trying to do something. All right, so this is a long-term view of Treasury yields. I think it's really important for us to take a quick look at this. I try and look at the market in terms of inter-market analysis, not just the S&P or the Nasdaq, but to look at all those different things that may impact sentiment. And 10-year Treasury yields is one of those big things people watch. What's interesting to me is if you look at this level all the way back to basically, this is a trading view chart, but if you look all the way back to basically June of 2008, after the in the midst of the financial crisis, yields were coming down, and then basically they had a brief spike, and then that became a long-term level that, if you look back here, when we started running up in yields, at the end of 2022, that was a big level that it took a long time to break. This level right around 4.25. So what's interesting is we see now that we spent all that time under 4.25 from October of 2002, basically through last summer when we had that final rally to the upside, or run to the upside in yields. But now what are we seeing? 4.25. We're stalling there. So I think right now it's interesting. Let's flip this over to a daily chart on TradingView, because it's easier to flip over this real quickly. This level now, if this does become a high and we see the potential for a move down in yields, that can have broad implications. And I think we need to be aware right now that there are things happening with yields that are probably not getting as much attention as it should. I think everyone's looking at the Fed, blah, blah, blah. And obviously the Fed's important. But at the end of the day, that 10-year Treasury yield is really going to be one of the key things people use for pricing a lot of different assets. And it's at a level now where it's struggling. And the next event going to be coming up, put on your radar real fast. March 6th, I think it's Wednesday of next week. But March 6th is Jerome Powell in Congress. And then after that, we have non-farm payrolls at the end of next week. So it's just kind of interesting here. The one thing I would say is there anything here that can drive yields higher in the near term? Take a look here at our rundown, and what you'll actually see is, on the calendar, as I look out, right here, our upcoming events at the very bottom here, we have ISM tomorrow, the Institute for Supply Management Manufacturing. That's something of a potential, we'll see. But, I think right here, Powell in Congress, that's kind of the big one. Institute for Supply Management it's important. Does it have the power to trigger a significant move in yields? We'll see. I want to just mention here that that 4.25 on the 10-year is a big level, and I don't think it's getting the attention that it deserves. So we want to talk about here. All right, so very quickly, I'm going to just run through some things that were popping up that were of interest, not of interest, but just looked kind of there's some interesting patterns that were jumping up just today. That could be some potential kind of signals. MPWR. Now, this is one of these. It's another semiconductor stock that is just kind of sitting, and that rising 21-day exponential. It hit that today, so it was on our radar. This is one of the scans we have set up that's built into the MT workspace, MT main workspace we work with. I'll show you guys real quickly. If we go here to our MA tools tab, I'm going to import the whole S&P 500, and then I'm going to go to S&P 500. It's going to load there for a second while I go back to this. But that was one that was just kind of jumping up. I was just doing some scans right before the webinar. Now, another thing, don't throw tomatoes at me for talking about a stock like Cigna. I know it's like really boring, but Cigna, Centene, and Molina Healthcare right now all have been kind of pulling back, and this is going to load this. It's loading all this other data, but all three of these now, have had some interesting pullbacks. Now, what I think is interesting in this market that I've been looking at is the fact that we're seeing companies making new highs, and the breadth is widening in the market. So as people start to look for new opportunities, there's money shifting potentially to some of these other areas. So some of these are just popping up because the name like Centene here, it pulled back. I think it's interesting that these health insurers, they got kind of hurt by some higher expenses and stuff. But those things don't last forever. These guys have the potential to, they're going to find ways to raise premiums and all that other stuff. So these companies are a mainstay of the economy right here, and I just think it's interesting to see these health insurers have been kind of starting to move. I also want to point out that the XLV, which is the health ETF, has broken out to a new high. Now, this is kind of interesting because, we have a lot of things here that, we had tech and all these kind of the NASDAQ and everything lead to rally, but now as the breadth widens, we're seeing more traditional areas like healthcare and industrials have been doing, pretty well. Financials have been moving, but now we're also starting to see the strength in materials. These are the kind of companies that can benefit as the rally widens. So just today, based on some of the things I was quickly looking at, I noticed these potential pullbacks in these names like CI, CNC, and MOH. These are health insurers. Okay, Ford. Ford Motor was interesting. It popped up on my radar coming into this webinar when it came down and held the 50-day moving average. Now, also very interestingly, it had a bullish inside day right there. So we saw some interesting sort of things like this. These inside days are just kind of popping up all over the place. Okay. Another stock that is not as well known, but it's actually been just running, and it's some kind of pipeline company. I don't even know very much about this, but MPLX. This one popped up for me because it was basically rallying up, hitting a new 52-week high, and now pulling back to that rising 21-day exponential moving average, right around the middle of its Keltner channel. Again, when we have a period here where money is moving to new areas, where breadth is widening, and things are starting to make new highs, these things could be in earlier stages of accumulation where there's not a lot of entrenched buyers or entrenched longs who are necessarily going to be, looking to exit. So, here's a stock that when you look at it, it's been moving, but it's gone from around 34, 35 up to like 40. Names like this, when you look at them, these are like a long-term sort of name. It's just kind of interesting to me that it hasn't moved that much. And at this point in time, these are sort of the things that we might want to be kind of thinking about, because at this stage, the move in the market is still relatively new. We broke out to a new 52-week high not even 2 months ago on the S&P 500, a new all-time high, I should say, on the S&P 500. So money is still coming into the market here, and we're not seeing yet that point when things get tired and they start staggering and they start making lower highs. We're going to get to the breadth analysis in a minute, but I wanted to just run through a few others that popped up just so if you're interested, you might want to look at PSX, oil refinery. Cyclical stock. This historic. Whoops, wrong. I'm sorry. PSX. Phillips, and the other one is MPC. I confused my two tickers. Sorry. So basically, Phillips is an oil refinery, but we're at a point here where as we move into the spring and the summer driving season, and also with a strong, with the overall economic activity strong, these are classic cyclical stocks, and a lot of these here are also, kind of near the bottom of some ranges after their own breakouts. Now, what's interesting to me is this is one that's near the bottom of the Keltner channel. We've talked about this custom indicator we've created, the Keltner pullback. It finds stocks in the lower half or near the bottom of that Keltner channel, and that's how this one came up. So I have a scan set up. I'm not going to get into this webinar, but essentially what I did was I looked for stocks where, like, for example, the 21-day exponential is above the 50-day simple. You can do something similar or different, but the key thing is this establishes that we have a stock that's in an intermediate term uptrend. Then we look for stocks where the Keltner channel, where it's near the bottom of the Keltner channel using the Keltner pullback tool, and a bunch of stocks come up. Now, we also could do something like stocks that recently made a 52-week high. That's something else that's built into this, the workspace that we have for you here. If you go over here to, I can actually, it's on price grid. I'll just add that over here very quickly to show you. There's days since 52-week high or low, and you can scan for those. You can say, let me see stocks that made a 52-week high in the last 10 days and are on the lower third of their Keltner channel. Boom, you can do that really easily and pull stuff up. We've talked about that a lot in other webinars, but here, days since 52-week high or low. You can see all these stocks that are near their 52-week highs and lows. What's interesting right now is we have a lot of companies making new 52-week highs. And once the market starts to do that, generally you kind of enter a period of broadening, lower volatility. Now, remember, one of the paradigms we work with is the market goes through essentially kind of different modes. One of those modes is consolidate, a kind of correlated move. When it's more volatile, it crashes, everything crashes, it rebounds, and then the indexes really lead that. But then when you get in this period where the indexes are making smaller moves, when volatility is down, it's the stock picking environment. And that's why we're looking for some of these sort of tools, some of these things to find these stocks that might not be as common. Um, WRB is an insurance guy. I didn't mean to pull this one up. All right. MPC and PSX. That's PSX, and this is MPC. Marathon. We had done a trading view idea, I think, on MPC a few weeks ago, based on this kind of the way that it was. You can just see it is forming this high basing pattern, these higher weekly lows, and we basically did an idea as it kind of broke out of this. There was like a descending little trend line here, and that kind of worked. And now it's consolidating. It's back at that 21-day exponential. Want to just point this out. Those are some things that were popping up on my list so far. Okay, some other names that was just kind of interesting. You know, it was earnings season, a lot of earnings coming, and I got to tell you, folks, I really like if you look on the FactSet website, they have a recap of earnings on Fridays. I'm looking forward to seeing that because one of the big narratives that is now emerging is that earnings are going to be better than people thought. If you look back, I think it was UBS about 10 days ago, they raised their target on the S&P 500, and one of the reasons was because they're forecasting higher earnings on the S&P 500. This narrative is now spreading. We're seeing a lot of stocks break out on strong earnings. For example, I mean, I don't even have time to get into all these and even to put my head around them. CEG, I mean, it's utility stock. This thing looks like a chip stock or something. It's a nuclear energy stock. We've talked about this one at various times, but I think the thing to remember is that these are breaking out. Look at, what do you call it? O'Reilly Automotive. No, I'm sorry. Was it AutoZone? I think had just this big breakout. I mean, all these sort of things right now are just people discovering new stocks. You know, taking some money out of Apple and saying, there's other stocks like Axon. What does Axon do? They do tasers and stuff. Now, the thing is, if you're a police department or if you're some kind of military or these different there's not a lot of vendors to choose from. If you're going to buy this sort of equipment, then these guys have really strong moats around their products, and that's what we're starting to see. Some of these companies that have strong market position that can dominate on the margins, and we're seeing that in a lot of areas. Quanta Services, an industrial stock that does things like different kinds of engineering projects and stuff. These are the names that are breaking out. And I think it's just important to realize that this is a different kind of market now. But another thing about these is most of these are cyclical stocks. There's something special at CEG. They have a special story with the way the Inflation Reduction Act came through and supported their business. But there's a lot of companies with a lot of stories. And, in the next week or two, we're going to run through our 7 key catalysts for stock movement because these are now starting to play out. And I think it's important just to realize that there is a historically abnormal concentration of of money in the mega cap stocks, various measures you might look at. So the thing is if that goes back to some kind of mean reversion, even if NVIDIA keeps crushing it, even if these companies continue to perform well like Microsoft and stuff, simply by the percentage of market cap they are and some of their higher valuations, based on what some strategists look at, those metrics alone justify them potentially underperforming and money moving to other parts of the market. And the thing is, if we see more M&A like we've been seeing, if interest rates come down, like potentially we're seeing on that 4.25 hitting resistance at the 10-year at the 4.25, if all those things play out, then this expansion of the market breadth does potentially make sense. Now remember, people have been talking about this for a long time and it hasn't happened, and that's true. But the thing is that in markets, things eventually, when you watch for them, doesn't eventually happen, but you might see something where you say this should happen, and it doesn't happen, and you have to wait for confirmation. And when you get the confirmation, then it makes sense. So one of those things for me was China. For a long time, I was expecting China to have just this contagion meltdown, and then it finally happened. And so now that it's happening, it's a view that I want to kind of stick with, and it has been working because we just saw today or not today, but in the last few days, I got to just go through and load these tabs again. But basically, there was bad news coming out of, well, there was something that was coming out of China, and it said something like, I'll find it here. But basically, just saying that the Chinese demand for oil is just not working out. Um, I'm going to find it. We'll zip through these headlines in a minute. But I want to just say when things are kind of when you expect something and you're too early or whatever, when you get that confirmation, well, you know what, we are potentially getting that confirmation now of the widening market, and that's why I'm kind of going through all of these. So very quickly, as I look at the S&P here, and we look at the actual, this is our our rundown for today, and so first of all, what was important to me, I don't have it on this chart, but let me just, this chart, and then I'll show the other one. These all show 52-week highs. And so basically here, when things just keep hitting highs, it's not bearish. So, I mean, I think that's the number one thing. We continue to hold this, 21-day exponential moving average. Look at these things we were just talking about, like monolithic power or, those oil refineries. They're all sitting in that 21-day exponential. So the market's bouncing at the 21-day exponential. And now we see, these things have been kind of, there's a similarity here. When you see these patterns, you know, it makes sense to kind of stick with them and to say, you know what, that 21-day exponential seems to be working right now. And it's also what you'd expect in a tight uptrend. Now, remember, I don't have time to do this, but if you go back to 1995 and you look at that breakout and that rally, the S&P barely went under the 21-day exponential during the initial move of that rally. And remember, we've talked a lot about potential similarities between then and now. So again, 21-day exponential is a sign of a tight uptrend. What generally happens is the market has a tight uptrend, and then after a certain period of time, which is maybe more like 4 to 5 months, then it gets tired. Then you get a big pullback to the 50-day or something like that, or it just goes sideways. And you're not going to try and predict that sort of thing in the future. But the thing now that I see is that when you get that breakout less than 2 months ago, the pullbacks are not. You're not going to just get a pullback to that old high very often, unless something really strange happened, like unexpected, something like we say we had a really bad inflation number or something got worse geopolitically, those sort of things. But in the absence of that, we basically have money coming off the sidelines. All right, so I'm going to just quickly look at some of these other patterns very quickly. All right, the advanced decline line here. Let's look now. All right, first S&P 500. 50, 30. Right here. This level, this high. And we ended up and it was like a resistance level. And from my perspective here, 50-30 is now an important sort of level. But it doesn't mean that we're even going to test it. But if we're remaining above it, again, that is a level that people might look to be retested, and it might not even happen. But the key thing is at this point, 50-30 was resistance level, and we ripped through it after those earnings from NVIDIA right here. And it's interesting now just to kind of we're staying above it. I think that's kind of an important thing to be aware of. Now I'm going to look on our MT breadth workspace. And so here are some things I think we want to look at. First of all, let me fix this here. All right. This shows the S&P against, it shows a SPY against the RSP. Oops, wait, I did something wacky there. Let me just reset this. All right. Now, RSP is the equal weighted S&P 500. The SPY is the capital market cap weighted. So what's interesting is, this is just a simple trick, is that when RSP is outperforming, it means breadth is better, and the opposite is true. So basically here, when we see this in the red, it means that the S&P is lagging the RSP, which means that it basically means breadth is better when this thing shows a negative. It's just the way this chart actually works. So it's interesting here is these are periods of mega cap dominance. Not surprisingly, New Year started. We got all that bullish news out of, it was Super Micro, and there was some others. It was Taiwan Semi. We had good news on the semiconductors. The AI story came roaring back in the beginning of the year. Then we had big tech earnings. And that's why the mega caps were outperforming. The large caps were all outperforming here. but now you can start to see that the equal weight is taking over again. So I think that's what we're starting to see here. It's showing this sort of wider market participation. We go here to SPY, and we can see that there are, I've talked about this, the number of stocks above the 20 versus the 50, but we're seeing more companies hitting 52-week highs. We're also seeing the advanced decline line pretty much continuing to confirm these highs. So this shows that we have, some breadth on our side. We also have the MTES workspace. And what's interesting to me about this one is you can see here the 50-30 line pretty well on the cash index. And then what's interesting here also to me is that this is just like this high kind of basing pattern on the actual futures. What's interesting to me is right here it was basically oversold. And now what we kind of see is we see it's above that 50-hour moving average, and that's starting to turn higher. There's always been something I've just kind of noticed at this point. I think it just it kind of suggests that that there is the potential here. If we hold to for just continuation. I mean, it sounds so kind of trite at this point in time almost, but there's just nothing here that's giving a bearish signal that I can see. If we look back over in the S&P here as well, you can see that we're actually making the low yesterday was 50.58. The low today is 50.62. Okay, again, slightly higher lows, and we have now a gap of time until Powell is in Congress. And the other thing is, it's possible here that everyone knows what's happening, and it could be a wall of worry. So one of the things I had kind of said, and it might have been premature, but I had said some time back, and I said it, right around here, that there was a potential for yields peaking, and then as it moved lower, for then the kind of, the breadth of widen and the small cap rally to happen that, people were waiting for. Now, that might have simply been premature on my part. I saw this high here, but now I think it's important to see if the if this does become the top. Something like Powell, he might just come out and say we're not going to cut interest rates in March, and then, well, guess what? That's the news that you go the other way. The market has now basically said, oh no, we're hawkish, because now we're not. We already knew that we're hawkish, right? So right now the news swings between a pendulum of being, is it priced in or not? And what you think you could say here is that at this moment in time, hawkish news is priced in. So when the news event comes, it very often goes the other way. And so I think right here, there could be a risk after Jerome Powell speaks next week. He doesn't say anything terrible. Then there's the relief buying in treasuries and the decline in yields. Just something to kind of think about. It's often how the market actually behaves. All right, let's go through some of these important headlines I wanted to show. But before we do that, I got to just show what I wanted to look at with the materials, XLB. We did a trading view idea on this, but it's really interesting to me to watch it. This was a new weekly high that we made here. Now, materials are cyclicals. These stocks have been really left for dead, neglected. If we look at it on the weekly chart here on TradingView, you can see as we took out, this was the highest weekly close, right, since back here almost 2 years ago. And so when you just start making those new weekly closing highs, there just seems to be this thing of money, sneaking off the sidelines. Remember last week we talked about XBI. We talked about this was hitting a new kind of weekly closing high, and it had that continuation to the upside in the biotech ETF. We talked about it a lot last week. So I want to just mention that, this signal has been popping up, and it's been kind of triggering things. So you look at the NASDAQ before it broke out to new highs. You can also see here that it basically went up, made a new weekly closing high, sat and chopped for a few weeks, and then continued higher. So very often you get that closing high on the weekly chart, and it just sits. It doesn't do much, and then continuation. So what's interesting to me right now in the material space is that is potentially what we're seeing here. And look on the daily, the point is it held this 50% retracement in early February. And what's interesting to me also is if you look at this high, I don't have my lines on here right now, but if you basically look at that high right there, it basically closed above, went down and held that December high, just really tight, and now continuing higher today. So again, this is when people are looking for a strong economy, things like materials are the sort of places that they might start to look. And I know that, we all have this obsession with technology stocks and semiconductors and all these sort of NASDAQ names and stuff. But in a strong cyclical environment, things like packaging stocks can actually, I mean, that's why I say packaging stocks, I'm going to get that. But this sort of, cyclical focus can really come to play. We haven't seen the market behave like this in a long time. So I think it's important to realize that as it starts to happen, you might see things that you haven't seen in many years. Years, not months or quarters, but like we're talking going back like, a decade since these names were performing. All right, now let's go through some of these. I'll just say that my in focus stock was Packaging Corp. Packaging, right? This is a material stock. So basically, hitting 52-week highs. Look at this. Hits a 52-week high, comes down the Keltner channel. That is the kind of signal I'm talking about. Now, we were noticing it because it was just kind of near the highs and it was in the material space. So I was just looking through stocks that were near their highs. And, I was just going back looking for earnings and stuff. Normally, when I do my mover of the week, it's going to be a non S&P stock. But this time it was just interesting to me to be focused on the material stock like this. The thing is, there's a few other material stocks that are not in the S&P. What's interesting, it's not the metals. It's stuff like chemicals and the packaging stocks. Just wanted to kind of share that. But this was exactly this sort of thing. No matter what, pretty much packaging is going to be economically cyclical. And also, they're not probably hugely exposed to China, unlike metals and stuff. So if you have more economic activity, people buying stuff in general, whether it's enterprise side or consumer side, packaging, cardboard, all that sort of stuff, there's a few companies that basically own that space. And they also, because you're dealing with like enterprise and stuff, you have significant market share protection. If you're like some manufacturing company and you're shipping out like components or something, you're not going to just go change your supplier of who gives you boxes or something. Like for me or you, if some food is too expensive, you go and buy something different, or there's price competition on the consumer side. But when you're on the enterprise side, these big giant industrial sort of things that is something this would do, if you're General Mills, I'm not going to say General Mills, I don't know who they do business with, but the thing is, they're not going to just go, oh, we're going to use someone else this week. These are long-term sort of contracts and businesses. And as the economy ramps, these guys are right there. They own that chunk of GDP. And that's why right now, that's how people are going to look at names like this. They're going to give that strong link to an accelerating economy. Remember, S&P Global raised their estimate on U.S. GDP from 1.5 to 2.4%. That's pretty massive. We've seen other things like that. The conference board said, you know what? That recession thing we were worried about, not worried anymore. So all these things kind of continue to point in that direction of cyclical strength, and things like packaging and material stocks fit that bill. All right, now let's go through some of these things here. My chart is being, all right, sorry. I use this thing. It's kind of cool. It's called Tabox. I don't know if you ever, it's a plugin for Chrome. It allows you to save a big bunch of URLs and web pages. So that's what I have here. But I want to point out a few things that were interesting to me in this. So jobless claims today were a little bit higher than expected. What was really interesting to me is that continuing claims were the highest in, or the 4-week moving average was the highest since late 2021. So this is kind of nice if you want to be dovish. Some of this data today, the GDP got revised down a little bit yesterday. So these things right now are not going to be ringing those alarm bells for Jerome Powell. And it's not to say they're going to cut in March, but it does just kind of help to say, you know what, things are not necessarily overheating. When you see higher continuing claims, it does show that the labor market is not as quite as strong as people think. And I've heard various things about, there's jobs that are, companies have not removed job postings. Now, this is anecdotal, but you look at the JOLTS data, it still shows about 9 million unfilled positions. But there's a lot of anecdotal people also saying, well, those jobs are they're out there, but they're not really being actively recruited. For example, if you apply for it, you're not going to get a call back. That's the sort of stuff that that I've been hearing in different ways or kind of seeing anecdotally, and this kind of confirms that. So I think the thing here is that this is a positive thing from a dovish side. Okay, next thing here, consumer prices. This was pretty much in line. But what was also interesting here was that personal income. This is the PCE, so it's the thing that comes out today, but it's personal spending, personal incomes, and the personal consumption expenditures deflator, which is basically an inflation number. The real thing to me that was interesting, this number, was that incomes went up by 1%, which is much higher than expected. Spending did not go up. So this is also consistent with what we saw in the retail sales for January, which missed by a mile. And some people said it was because of bad weather. So I think it's just interesting here that we see this is consistent with that, which is that basically spending was weak, but it's interesting to see incomes go higher, because over the long run, I think that we are really setting up for that kind of that kind of perfect balance of incomes rising as prices fall, or as prices just at least moderate and inflation slows. And that narrative seems to be getting confirmed by these numbers that we kind of see. So this income was very interesting to me. Okay, now Goldman Sachs earlier this week, they put out a note basically saying that positioning and sentiment, can basically, people can increase positioning, which essentially means that they can increase leverage, they can take more risk, and this is the sort of thing that you would see of things like um, risk on, stock picking, individual names outperforming, and stuff like that. So Goldman has a proprietary model for assessing this. And in my view, I just look at things like the VIX. I look at things like, stocks above like the 50-day moving average, or some of the things I was showing you in the breadth indicator. But we kind of have that sense that usually the market has a strong correlated rally, then it goes into a more gradual period of advance with individual names starting to move. And that's kind of what Goldman is saying, the same thing that I've been talking about for a while here. Okay, NVIDIA earnings. This is an interesting note, but UBS said it could be, fuel a roaring 20s. Even before AI came, I was expecting a roaring 20s, because I was looking at the improvement in the job data immediately before COVID, and I was looking for a rebound in housing. I didn't even have AI on my radar, so it only adds to that. But I think it's interesting, that the roaring 20s, it's 100 years ago, but it was basically the first, not the first, but it was maybe the first tech boom. It was things like General Electric toasters and things like that. That's what actually fueled, the roaring 20s. It was industrial stocks that were introducing what was then cutting edge technology. And so a bull market can be associated with a specific kind of technology. It's not always true, because I do think that if you look at what's happening in something like Japan, it's not from that. Other things can cause bull markets. But what's interesting now is having that AI. Not only do you have individual companies, but you also have something that's going to have an impact on earnings, productivity, inflation, a lot of different things here with AI. It's going to boost productivity in a significant way. And, we are seeing it. And then it's also going to, drive demand for products. So it's interesting here to just see this note from UBS. Interesting thing here, this was from Deutsche Bank, I believe, that we have more companies buying back stock. That's also, kind of this. This is interesting now, if you look at credit spreads. Now, I've generally believed that when you see better, credit spreads, you typically do see them, equities perform as well. People don't think about this, but stocks are basically like sitting on top of, it's like I don't know, it's like some kind of balloon or something. I don't know. It's like a big blow up house. And then on the bottom you have credit, right? And then on top of it you had stocks. And like most stock investors look at the top, and they know it's great, the stock market's going up. And they don't look at what's happening on the bottom, which is basically that when companies' credit improves, it increases their profitability in various ways. It makes it easier to do things like invest, buy back stock, buy other companies, make money in general, because you can refinance your debt at lower rates, and all those things. And the other thing is, it shows confidence that companies are not going to go bankrupt. So there's many positive things that come from this. But credit spreads going tighter, it basically means companies are borrowing more cheaply. It means that those companies, when they sell bonds in the market, that they are getting more, they have demand for it, and people are willing to support it. So anyway, this is another thing that confirms that story. Let me just see quickly. I have a question here. Does the increasing breadth in the market have anything to do with PE ratios? No, I don't think it does. On one hand, PE ratios have risen. Well, maybe it does. I mean, all right. So PE ratios have risen because the market is anticipating better earnings down the road. So maybe that expectation of better earnings is also associated with breadth. There were other times though when P ratios really shot up and it wasn't necessarily associated with good breadth. If you look back in like 2000, I mean 2020, P ratios were through the roof and half the market was dead in the water. Like all those cyclical stocks. So in my view, I wouldn't really associate those. I think if anything, I'm trying to think the right way to put it. I mean, this data is not readily available, but what's happening is the fact that the big companies have a higher multiple relative to everyone else, and there are ways to do this analysis. And I've heard people like Tom Lee from Fundstrat talk about it, basically saying that if you look at the earnings of the S&P X Fang or whatever X mega caps, it's 15 times or something. So I think right now the I would not make a link between those things per se. Okay. So here we have Citi saying a rate cut by the middle of the year. I don't know. Honestly, I think the Fed is not as much of an issue now. Bostic, he's back as a voter now. And what's interesting to me was even with the strong GDP and everything we're seeing, these guys are still talking about rate cuts this year. They could say, well, maybe rate cuts aren't warranted, but they're still talking about it. And so it's interesting to kind of keep that alive. And I think we're at a spot now where, you know, we might get one cut this year and the market will be fine with that. That might be the crazy thing. Maybe we don't need three cuts the way we expected. Maybe the market just doesn't care. Earnings grow because the economy grows. And then we get one cut, and that's good enough. And in many ways, the fact that we don't need to cut rates is the reason why the market's going up. I mean, it's kind of crazy that we thought we need the Fed to cut rates for the market to go higher, and now it's just the opposite. Now it's that basically the market's going higher because the Fed doesn't need to cut rates. It's a crazy sort of situation, but you know, one of the things I always say is that in finance, nothing is always true. Um, good news can be good news, but it can also be bad news, as we all know. And 2 plus 2 is always 4. But aside from that, there's nothing that's always going to be true in the stock market. Sometimes good news is good and whatever. And so I think right now it's interesting to see here that the Fed continues to keep this narrative alive. All right. So it'll be interesting to see if they start to take away the rate cuts, though, in the March dot plot. Just interesting here, Citi saying that this idea of commercial real estate is not as bad as people thought. Um, I don't know, but it's just one more of those things that becomes a brick in the wall of worry. Now, interesting here, there's this thing, Elon Musk basically attacking Google for their AI. I think it's interesting now is that whatever you think about Elon Musk or anything else, but I do think now when you look at Google, it's had some patterns that are potentially worrisome on its chart. This was to me particularly a problem here because you had a lower high. This was an all-time high false breakout. So we did a thing a few weeks ago when we basically looked at Apple trapped below its all-time high. It compared it with Microsoft, which was above its all-time high. We looked at Toyota versus Tesla. Toyota, wow. I mean, versus Tesla. All right. So that's kind of what, the point was. The point is that the companies that have better fundamentals, it's on the chart. So in my view, now the Magnificent Seven has basically broken up into the Fab Four and the Troubled Trio. I call the Troubled Trio Alphabet, Tesla, and Apple, and the Fab Four are Meta, Nvidia, Microsoft, and Amazon. So I think that we see this now, but it's interesting that I think the word on the street is that Apple is struggling. And honestly, this chart to me, one of the things my signals here is the fact that Apple here is just this 180 level is trying to just hold on desperately, but can it? Because this is pretty interesting here that this downtrend is kind of taking shape here, and I think this might be something people look for. If we get a close, maybe not exactly 180, maybe it's close to be kind of, I don't know. Looks pretty bearish actually. I was just looking at this level on 180, and money is moving away from Apple, and I think when you really look at it, I mean, honestly, Apple has been, I think, resting on its laurels for a long time, and the I think they can only things seem like they could get worse before they get better because at this point, they're behind the curve on the AI thing. I think we all know that. But then the other thing is that um, there's just a lot of evidence that the iPhones are not really doing amazingly, and it's an expensive stock. So I want to just mention Apple to me remains kind of one of the problem parts of the market. But um, this whole thing, Google as well. So we mentioned Alphabet making this lower high, false breakout to me. This is very troublesome technically. Lower high. Now it's under the 50-day. Now again, there's a major stock. So right here it has this, level. The idea is something like of Alphabet just crashing is, you know, not massively likely. But I think at this point in time, you're looking at a company that is, you know, has risks of underperforming because the fundamentals are really not clearly as strong for a name like this, and the market knows it. See, same thing here. These seven names will not rise together anymore. It's exactly what we're saying. This was some guy at Jones Trading. I just saw this. I look at Benson guy, look at Seeking Alpha, look at Reuters and all kinds of stuff. Amgen, it's interesting here. You might want to just check this out. I don't really know what to make of Amgen here. It was one that we had talked about with a breakout and it worked. And then it basically had a bad earnings report. And we said a week or two ago that, it was pulling back good and we wanted to watch and see if it starts to bottom or stabilize. I don't know enough about it. My biggest view about Amgen is its problem might be that it's not a takeover target. But this company fell on some worries about its product, and we might start to see at a point here where people start to say that this is overdone, this kind of pullback. But I want to just kind of put this on people's radar because this company was hitting new highs, and I think this is just kind of interesting to see if it does start to kind of stabilize. They had this some upcoming events. You might want to just kind of check this out. It was an article on Benzinga on the 26th. Not really. Going to say anything too clearly about it, just that this is a member of the Dow. It was an outperformer. It was performing very well, and now it's gotten really hammered. So might want to check that out. Micron basically has started doing some AI stuff for NVIDIA, which is interesting. All right, here's the article I was talking about. China's oil demand recovery growth could be half what it was pre-COVID. So it's like we said, China is, really in a tough spot here. And, my thesis on this has always been that China is struggling with, a debt crisis. And it's one of the easiest things in finance to understand when you have too much debt and it just becomes a debt spiral down. But we're just getting continued confirmation of it. And it's interesting to me to look at energy here. If we look at crude or anything else, I mean, it just has been hitting this kind of resistance here. XLE, all these have been just trying to kind of break out. Last week, we kind of said we wanted to see if energy would break out, and it's just kind of sitting there. And it's interesting, my view has always been, well, not always, but, I've been talking about the problems of energy since back years, even right after the whole situation with Israel started. We started talking about the whole, Gaza thing. We started talking about the fact that supply of was going to become a problem for crude, and it very much has been. OPEC is now talking about, more high cuts. I don't know exactly, like, me right now in energy, I'm not really sure what to think. I think that if they announce some kind of ceasefire, that this could be, pretty, people could sell it. The risk is maybe that if things don't, then we do get some kind of break higher. But I'm just kind of watching energy here because it is, the oil producers themselves, are not in a, the crude oil prices themselves have, probably some downside risk. The refineries though are something different because those are, it's interesting to see how the refinery stocks, like I mentioned earlier, have decoupled from the oil and gas drillers and from oil prices. It does show the market is looking for the companies that have the exposure to the cyclical economy versus the companies that have exposure to more of the global economy and demand because, an oil producer, a driller, natural gas producer is going to be exposed to China, but a company that makes gasoline for American drivers is not. And so the market is seeing that split. Might be a ceasefire in Gaza this weekend or early next week, so says the White House. No, I know, I've been seeing that. And we've been hearing it for a while. And I don't know what to make about geopolitics. That's the thing I'm saying here. I think the whole market's expecting it. And my perspective would be that there's a range here, and you can see between on XLE between 87 and 80, it's this range forming. And my view would be that if the ceasefire happens, this could be a move down to 80 could be what people look for it to kind of fill that range to the downside. But again, the fundamentals, we had more crude oil builds this week, so the fundamentals in energy are not good, and it really is kind of right now something of a positive for equities and for risk right now. If we can basically see, weakness in energy. I'm running out of time again, but OPEC cuts, Barclays raised their target because of profits. I want to just mention this again. This earnings narrative is a big thing. We also did this special report, kind of comparing now to back in 1995. You want to check this out? There's a link in the rundown. I want to mention here that the rail traffic is interesting to look at. This is from the American Railroad Association, but we're now seeing this is the current year. What we're basically seeing is we're seeing rail traffic is the highest in the last 3 years. I think this is an interesting thing just to be aware of this line. If you go to AAR, if you just Google AAR rail traffic or something, you'll find this. It comes out every week, but this is showing again cyclical economy. Railroads are industrial stocks, right? Don't forget that. All right. We're also seeing that the bearish sentiment here is kind of collapsing. This might be a sign of kind of the market peaking or complacency, or it might also be a sign of just greater confidence in what that could do for market breadth overall. These are the main things we're going to look at. All right, I'm going to very quickly show you now doing some stuff with inside bars. I'm going to open up a new workspace very quickly. I'm going to create radars. I'm going to open a radar screen really quickly. I'm going to do a really quick chart. I'm going to bring in the S&P. I'm going to make it. All right. So inside candles, these are show me's. They're not indicators. Similar, but they're categorized differently. I'm going to make this weekly really quickly. I'm going to select all time frame weekly. Then I'm going to go to studies, add study. I'm going to go to, you're going to see here as it comes up. I want to just show you how to do this. You're going to go to show me, and I'm going to go to inside and outside. Inside bar, and then outside bar. Okay. Now I'm going to actually change this really quickly and make it a little bit bigger and easier to read on the webinar. Just change my font. Just make it like 14 and 14. Okay. I'm going to remove all this other stuff just to see things more easily. We don't need volume either, just for this purpose. All right. I like having my interval though, because it shows. So this will basically plot a value if you have an inside bar or an outside bar. I'm going to go here to just add a chart. I'm going to make it a real quick green symbol linking. I'm going to make this here time frame weekly. And now let's look at what we got. Oops. Inside bar. Invesco. IVZ. I haven't looked at this one in a while. And so what this one will do is this will show an inside bar last week. It had an inside bar last week. And you can see right here, Invesco, this here is an inside bar. Now, if you want to see it on the chart, you can go to studies, and then you can go to add studies, and then you go to, again, you're going to select it as a show me, and then you're going to go to show me, and it's like inside bar. I like to make these, I like to use white crosses because sometimes colored dots I cannot see, or they confuse me with moving averages. So I'm going to make it white. And I go to style, make it a cross, and boom. So you can see it's an inside bar. So then we can see these other ones had, inside bars as well, and that's how it pops up. Now, if you want to use it in Scanner, I have instructions on that, but it's basically just like a study. And then you can see these are also going to be outside bars. It's going to show the last price basically. So right here we have an outside bar. So that's just kind of an example that right now we're in an outside bar. So the thing is that this is the sort of thing that in the morning you can look at to see companies at inside days yesterday. You can find it to start looking for things that might be starting to break out. But I think right now in this kind of tight market, things like inside bars can be very useful. Inside and outside bars. They're not just something you want to just instantly follow, but when you saw something yesterday, like AMD forming this inside candle on the daily, you can see right here. That's exactly what I'm talking about. So you can also, you know, you can control the time frame, and this is weekly and this is daily. But this is the sort of thing if you were looking for things like this. The last thing I want to show you very quickly is, all right, how do you do it in Scanner? I'm going to go to New Application Scanner, and then basically let's just do a really quick. I'm going to make the font bigger again. All right, just very quickly show you how to do this. I'm going to go to create a scan. Just call it, 20240229 inside bars. Just to make things simple, I'm going to just do the S&P only so it's not too slow. I'm going to do all stocks, but I'm going to give it a really high threshold on market cap. I'm going to say market cap of 10 billion. All right, and then I'm going to go to, I'm going to go to indicator. And then I'm going to go to, wait a second. On this one, you want to click on, go down, it says show me. That's separate. So just remember to show me if you don't see it. So I'm going to go to inside bar, right? Inside bar. Now, the one thing about this is it's considered like a Boolean or a true false value, just so you realize it's not greater than or less than. You just set to true. You should notice that you can't click these. The only thing you can click is true, and then hit run. And let's see what it gives us. Now, you can combine this with other things. You can scan for stocks that, are at a certain moving average and have an outside bar or something like that. Let me very quickly look. If you look at something like AMD, I think it would have come up on multiple. See, it was at the 8-day exponential. Yesterday, I honestly was, trading some of the chips based on this. Right at the close, I noticed I'm not going to tell you which one, but there are certain chip stocks I noticed were at that 8-day. So you can also do that very quickly. Go to MA Tools, and you have this. I'll show this to you as its scan is running. EMA test. This will show you stocks that right now are touching the 21-day exponential. So we have Citi on the list, for example. See, it's sitting right at that 21-day exponential. And yesterday, AMD was at it along with some others. So I just always have one of my radar screens that tells me when things are at like the 21-day or the 8-day or whatever. And so you can just go here to EMA test. You can go to studies, edit this, and you can change it to 8. Right? And it will tell you something different. And you can find stocks that today are at the rising. You look for it green with a plus sign. And this will then tell you stocks that are, Amazon today, for example, came off that rising 8-day, things like that. Another trick you can do is you can say studies add study. You can go to EMA test. Well, you can see here, actually, I already had it. Sorry, I have the 8 and the 21 already set that way. So you can add different ones, and you just go in here and you actually change the time frame. Studies, edit, EMA test. Then you just change the period. And this thing is set up so it tells you if the EMA is rising or falling. It actually has some pretty sophisticated logic in it to not give you false signals. So I wanted to just kind of tell you, it's one of my favorite custom indicators that we created for you guys who love all the power of what the award-winning TradeStation platform can give you. All right, this scan ran inside bars, and here we kind of see, here's our results. Let's just sort by market cap. So apparently Apple, let's make this green. Let's see what happens. Let's see, Apple had an inside bar yesterday. Now, I will say that in my opinion, inside bars are continuation patterns and outside bars are more of a reversal pattern. In and of themselves, I don't always really, I'm not a big believer in just trading candlesticks. But the thing is that when you have things that are in uptrends and you get something like a tight inside week, you often get continuation. So one of our trading view ideas was Caterpillar. It actually had changes to a weekly, and you can see that it completed a bullish inside week here. A bullish inside week is continuation pattern. And so it can be good to look at this on a weekly basis. You can look at a stock that, for example, you can do this with Scanner because you can use multiple time frames. You can say, I want to see a stock with a 21-day exponential is above the 50-day simple. and it had an inside week, for example. Maybe we'll show that in sometime in the future. But anyway, great to talk to you guys. We'll be back next week. Thanks for joining us. And remember, we do this every Thursday at 2 p.m. And see you next week. Thank you very much.